So in order to get around the regulations that restricted banks from paying interest on deposits, banks came up with a new product called a bank repo or a repurchase agreement, which was another good source of funds for banks. So let's look at this topic very closely in depth as it's very relevant to our scope. Due to the interest rate restrictions on checking deposits placed by the Glass-Steagall Act, banks were at a competitive disadvantage when interest rates rose, making them create innovative products around these restrictions. So the Glass-Steagall Act placed a cap on interest rates on checking deposits. The bank would perform a bank repo with a loan customer by selling and buying government securities with a client for a short duration. Let's take an example to understand this. Let's take the case of the AAA client. Now, AAA has a $1 million loan outstanding with the Bank of Metrocity. However, due to regulatory restrictions, Bank of Metrocity cannot pay interest on the deposits to AAA. So AAA and Bank of Metrocity enter into a bank repo where at the end of the day, the deposit at Bank of Metrocity is converted into a secured loan. The loan is secured by risk-free securities such as government securities. The loan is created by the sale of securities by BOM to AAA with a simultaneous buyback the next morning at a fixed price. The price is fixed depending on the interest rate that BOM wants to pay AAA. Let's take an example to understand this further. Assume that Bank of Metrocity wishes to pay AAA 6% on non-utilized deposits. So, on a $1 million outstanding deposit, BOM sells securities for $1 million to AAA overnight. The next morning, BOM buys securities worth $1 million plus the 6% annualized interest rate. So assuming a day count convention for repos at actual by 360, BOM buys back at $1 million plus $167. So the next day, AAA's deposit is credited by $1,167. If the funds are unused by AAA, then BOM and AAA enter into an overnight repo again the following day for securities with this new amount, $1,167 amount. So this arrangement has benefits for AAA and BOM as well. Since the required reserves are calculated as a percentage of the deposits at the end of the day by the central bank, the deposits at BOM are converted into securities sold each day before the close of the day. BOM can hold fewer reserves. At a reserve requirement of 10%, BOM can reduce its reserves by roughly $100,000. A repo transaction is considered a borrowing rather than a deposit, hence escaping the reserve requirement. Now there is another concept that we need to study when studying repos, as we will come across it when studying the Federal Reserve's monetary policy, which is reverse repos. Basically, one party to a repo transaction is performing a repo and the other is performing a reverse repo. A reverse repo transaction is when the bank wishes to borrow securities in lieu of cash or deposits. Now let's take the example of a bank called Central Bank performing a reverse repo transaction with Repo Bank. Central Bank purchases securities worth $100 million in a reverse repo transaction and in turn credits Repo Bank's reserve account with cash worth $99.5 million. Now, even though the securities are worth $100 million today, they may not be the same market value when the securities are sold back due to market risk. So this reduction of the cash value of the security taking into account market risk is called a haircut. Now, if the transaction were a term repo with a tenor of 1 week, central bank sells securities back to repo bank after a week at the $99.5 million plus the interest rate, which is the repo rate. From the central bank's point of view, this transaction is a reverse repo, and from repo bank's point of view, this transaction is a repo transaction, a repurchase transaction. So the repo and the reverse repo transaction is an important concept to remember and to understand, since the Federal Reserve Bank uses this as a tool to implement its monetary policy, which we will see very soon.